listening to The Voice of Insurance. I'm Mark Gagan. Today's episode is a real cracker and part of a series of great episodes we've got lined up for you in the month of September. Laurent Rousseau is the Deputy CEO of Scor P&C and is a rising star in this top-tier global reinsurer. In this podcast, we talk about the dilemma facing Lloyd's of London, the Insurtech phenomenon in the era of the now publicly quoted lemonade, the intimate details of what is driving the hardening global insurance and reinsurance market, the class of 2020, and the boom conditions for specialty insurance. If you want to know what's going on in the world, you need to have access to smart and well-informed people like Laurent. And that's what the Voice of Insurance is all about. I've known Laurent for a few years now, and I very much want you to meet him. We've got a lot to get through, so let's get straight on with the podcast. Before we get started, I'm here with Rick Lindsay, Chairman of Prime Holdings and the CEO of Claims Direct Access, who have kindly supported this podcast. Rick, first, thanks so much for your support. Why don't you briefly tell us about the Prime Group and CDA and what they could do for our listeners?
Sure. Prime Holdings is a holding company, and we're excited to expand our claims TPA service, Claims Direct Access, which is the exclusive claims manager for Prime Insurance Company, and has managed claims for Lloyd's since 1995, when we've been on the Lloyd's line slip as a risk taker. So we plan on coming over to London and hopefully providing our partners more flexibility where we can issue prime paper where necessary. We can support and take risk on the Lloyd's line slip and offer our superior claim service, which is evidenced by Prime's own loss ratio for the past 10 years. I believe that claims is the key to success in our business. That's really the only thing we do that adds value. Obviously, you can be a good underwriter, and if the claims falls apart, the underwriting's a waste of time. If you're a good underwriter, you need to balance the scale with good claims. So again, we're excited to bring superior claim service to the Lloyd's marketplace and offer the ability to share risk alongside them as we manage the claims.
Well, thanks so much, Rick. I'll make sure there are all the right links in the podcast notes, and let's get on with the podcast. Laurent, thanks so much for giving us the time to talk to the Voice of Insurance.
Thank you.
Let's just jump in and talk straight about the marketplace. It couldn't be a more interesting market. And I suppose in reinsurance, it's all about capital in one way or another. Do you think this is a market that's being driven by any kind of real capital shortage?
No, I don't think so. And if you look back probably past 20 years, capital has been flowing through every single asset class, every single risk-bearing business. And capital is a commodity. So as such, capital is available. And I guess the response to COVID-19 from central banks, from governments, have been to add even more capital. So if anything, we are now left with multiple times more capital in the system than what we were 9 months ago. So the shortage of capital is not the actual matter. The actual matter which drives the market correction is the remuneration of capital and the risk awareness driving the expected return on that capital. And this is really what had been already changing. If you look back a couple of years ago on the insurance market, and really this hard market had been so far insurance-led, which is quite not unique, but original. Most of the previous hard markets were reinsurance-led. That one was insurance-led and progressively gathering momentum. And I really think that the COVID event is accelerating that and making it progressively a reinsurance hardening market. But so what's really the driver here is what should be the right remuneration of that capital in an environment where the risk aversion has just shot up to the roof.
Is it really about discernment? Is it just that you're saying, I want to make sure I hit my returns this year and I'm not going to change my view and I'm going to decline business if it doesn't prospectively hit my return these days? And it's nothing to do with whether you'd say that you've got plenty of capital available to you, but not at the wrong price.
Yes, absolutely. And you want that, capital allocators, if you wish, investors, insurance capital providers want safety and they want to manage downside. So the question is, if you put your capital at risk, what will be the remuneration for a perception of a risk that has really increased? So it is completely discernment, as you say, and the expected return on that capital. Way more than do you really lack capital. There is a little bit of a capital shortage, if you wish, in the ILS space, and it's because the capital is trapped, the capital is blocked. And here the latest stats as of the half year 2020 show a small contraction. So here there is more of a fungibility of the capital which is trapped. But by and large, there is way too much capital in the system altogether.
You mentioned COVID-19. So is that really going to be the straw that broke the camel's back then, in terms of to really stiffen the resolve? If you didn't already need more resolve, this is now you've got so much more material uncertainty going forward. You're going to be telling all your students, well, if you want us to be around, then we all need to be in this together and need to increase pricing across the board.
Yeah, it really reminds me of the timing and the catalyst when I entered the industry in the early 2000s. There had already been a progressive hardening. The casualty crisis had been already doing its work, and then bang, you have this major cat 9/11, which precipitated a number of already existing ingredients, if you wish. And will COVID-19 act in a similar way? Look, I don't have a crystal ball, but I think there are some very strong reasons to believe so. And
does it bring that fear factor that you really need? Because, I suppose I'm going back to 9/11, we're talking about, goodness me, is terrorism insurable? I remember at the time saying it's not really modelable, it's not really insurable. What about aviation? It's crazy. I didn't realize there was so much clash in everything. And there really was the fear,
Absolutely.
Do you think COVID's going to give that fear factor that's going to boost pricing?
I think it creates uncertainty. And with that uncertainty, clearly, that fear factor. I think something that we probably haven't measured completely, and we all tend to have, in particular in the London market, a focus on P&C lines. But if you think on the life side, this is the first fat tail event. This is the first dot on the fat end of the tail. I mean, the previous one was Spanish flu at a time where the economy had nothing to do with what it is, and the world had nothing to do with what it is. If you look on the P&C side, I mean, since the 80s, we have actually fairly reliable curves, modeling. Each time we have an event, we can plot it on a curve. On the life side, it's actually the proper fat tail event. So I think alongside the fear factor and the general uncertainty, the question that I have as well, and things that we are discussing at Scor, is to what extent is it going to affect the life insurance and reinsurance market? To what extent are we going to have more price elasticity on the life side? We will all be used to saying that, life insurance and reinsurance is an actuarial business. You look at longevity curves, there's some mortality peaks here and there. But by and large, the price elasticity was extremely low, if any. And I think there is an event discovery, a price discovery process on the life side, which I find personally very interesting as well.
COVID-19, do you think this is the sort of loss that a smart underwriter can somehow outrun? Or is it just too late? And for a business like Scor, I presume, because you're everywhere and you're almost permanently on risk for everything in different ways.
The one area that we are not operating in and which got hit pretty hard is the contingency business. We're not a contingency player, so admittedly we have some residual exposure in certain treaties, but that's marginal. But we only disclosed our COVID exposure in Q2 because in Q1, when we saw the first hit from our competitors, was really coming from the contingency event cancellation business. And that's a market that is very specific, which we consciously didn't participate in. So we've avoided that one. But other than that, I think the contagion of COVID-19 effects is general. I mean, it's the very nature of that event. I mean, the event is, we still speak about it as if it was well known and in the past. I mean, it is going on, right? The event is still happening. So drawing any kind of conclusion on it is by definition premature. It hasn't ended just yet. But we know for sure it's global, it's continuing everywhere. So it's very hard to avoid any kind of effect and impact.
So take it from what you're saying, you don't suddenly see that contingency might be a good opportunistic entry point for Scor now to take on some new risk? Or do you think that's even insurable now to include second wave or that kind of thing as the economy reopens?
Yeah,
is it insurable?
We don't see it as an entry point. We don't see it as an opportunity. You could, of course, provide some covers, like we see some pandemic covers being brought in, but if it's to have a super expensive product or a cheap one with no value, we just don't think it makes sense. So even though we see some competitors getting into the contingency market, we don't see it ourselves as a primary of interest for now.
Laurent, let's go back to what you said about this being more at the beginning of this hardening phase, that it was an insurance-led thing, and that now you said that COVID might have now made it a reinsurance-led thing. Normally we'd be talking around this time, or certainly next week or the week after, we'd be hopefully sitting in your lovely lounge in Monte Carlo, where of course we start to talk about 1/1 renewals. So feeding that, do you think the 1/1 renewal will be the point at which the reinsurers really do take control of this market hardening?
Yeah, so I don't want to kind of pick on words. Taking control is not what we would look to do anyhow. And in reality, we've already had a few renewals that have been tested by COVID. The 1st of April renewals are the first one, actually. Even though it was only just starting, we had some exclusions discussions as early as 1st of April renewals. And then June, July were obviously very important dates. So what we saw then, and those trends have been accelerating, so I would expect them to keep gathering pace till 1/1, is indeed having a more balanced discussion on the renewals. For sure, there is a live event, there are exposures all over the place. And so I think that leads to much more balanced discussion than what we've seen in the past 15, 20 years, which was really a softening market, soft and softening market. So I think there's going to be a lot more balance, that's for sure. The second point I would say is we already see it. We are in discussions with a number of our cedents on their known exposures. And here, the discussions have been on actual live claims. So the discussions have already started way earlier than what they would have with the cedents teams, with the reinsurance buyers. And I think the natural discussion, and actually we're going to keep Monte Carlo but in a virtual way. So we have kept, if you look at my diary this year for Monte Carlo, it's pretty much as crazy as what it is when we are live in Monte Carlo. Just the difference is that we're going to be just like today with you, Mark, behind two screens. So we're going to have a lot more of balance talking of the actual claims. Some of our cedents, those who had to communicate to the market, so listed insurers, quite a few of them have taken some assumption on how the reinsurance covers would respond. And if you look implicitly at how reinsurers have communicated on their own exposures, they have made their own assumptions on how the covers would respond. And if you could make that exercise of comparing the pitch,
Are there going to be some differences of opinion? Are you saying?
Of course there are. And the question is, how did you bridge these? And the renewals are an important bargaining power element. Whether it is in favor of the cedents or the reinsurers, I think it's too early to tell. And at this very early stage of 1/1 renewals renewal process, I can only hope that everybody will be reasonable and long-term focused, not trying to take control, as you say, or kind of be oblivious of the situation.
And under those circumstances, I presume you're always a kind of partnership reinsurer. If your cedent who's coming up for renewal, if you've already perceived that they've done a lot of that hardening or that market correcting for you, then are you just happy to continue to support them? And others, I presume, that you don't feel have done enough, you're really going to lean on them, I presume.
Absolutely. And about 2/3 of our business is proportional reinsurance. So by nature, we are very defensive, close to the insurance market kind of reinsurer. We're not operating so much in excess of loss and so on. So we're going to be very keen to understand what are the measures being taken in the primary operations, and indeed ensure that the commissions and so on, the proportional cover allows us to take advantage of those measures being taken now.
Going into these renewals, what is your current feeling around rate adequacy? Are you getting a good enough price for your cover at the moment?
Well, of course, I would have a biased view on the matter. So I'll try to be as balanced as possible. I think you really need to look at to differentiate short tail from long tail, because alongside COVID crisis, you've had interest rates, in particular in the US. I mean, we know that for many years we're going to be in pretty low interest rates environment. And this alone has a hit on long tail classes. So we have seen, of course, long tail classes respond not as much as short tail. And what doesn't help is that we lose financial income on those long tail classes. So I think the adequacy is clearly not the same for long tail classes than what it is for short tail classes. And so I think we've seen a number of short-tail classes responding pretty well. And here the rate adequacy has been improving. Is it there? I mean, I want to avoid sweeping comments. I mean, Asia Pacific has nowhere near hardened as what we've seen in the US, for example. But by and large, the short-tail classes have been responding a lot more. Many of the market subsets are indeed adequate and more than adequate. We're making good returns again, which we hadn't seen for a while. In the US, it's second year of rate hardening, of market hardening, so it's year-on-year increases. So we're getting to some interesting situations on property classes, in particular in the US. Asia remains very competitive, with the exception of a few markets like India and Australia. And in EMEA, I mean, that region, if you look at Europe really, has remained, I mean, rates haven't responded so much. So here we would expect rate adequacy to have to improve from where it is today. Personally, if you ask me, Mark, I think the hardening that we are going to see in reinsurance is going to be a progressive one. I mean, this is a market, an event that is not as a hockey stick reaction like you would see in a property cat event. This is much more akin to a global man-made casualty type event where the hardening is going to take place over time. The distress is going to be appearing, I think, over time as well. There's so much uncertainty in the moment that there is flexibility in the way you put your loss picks. So I think the hardening is going to respond in a symmetrical way. It's not going to be spectacular hardening like the one you would have seen in the early 2000s. So that hardening is going to take place. This adequacy is going to improve over time, but you should expect casualty classes the rates to respond multiple the times of property rates, which is clearly has not been the case so far.
By implication, we're talking about, rather than being hit by a KRW year or something like that, we're talking about lots of slow, painful cuts that happen over a longer period of time, which reminds me, we've spoken about the uncertainty of COVID. I wanted to ask you about the uncertainty around casualty reserving in general, and perhaps in particular in the US. Do you think some of that reserve strengthening has got more to come? And will those original loss trends, do you think they're going to continue to worsen?
Well, I think that there's still quite a way to go. I mean, we all talk of COVID, but COVID is just a catalyst.
Yeah. Because I'm talking here more about the non-pre-COVID US casualty reserving question or global casualty reserving question.
So if you look at social inflation hasn't taken a break during COVID. If anything, COVID has exported, if you wish, social inflation from the casualty area to the property area. The interpretation of property contracts has led to, again, huge disputes, and there will be way more. So I think, if anything, COVID is clearly accelerating social inflation. We're going to see more cases. We saw that at the very beginning where there was questions about questioning contracts, insurance contracts, whether contracts should not be reviewed with a retroactive effect. So, and this is, call it social inflation, call it kind of political inflation. So it seems that, I don't want to be overly optimistic, but it seems that we've passed that point where people have gone again back to the value of contract, to the value of trust in the contractual relationship. But yet we are still seeing a number of cases. They're on the rise. We'll see how many class actions there will be. So I think, the reserves adequacy or inadequacy is only going to be appearing over time. We have been in this phase, Dowling called it this cheating phase, where the reserves excess can be released while actually the underlying quality of the pricing is clearly insufficient. So you can yet underprice your business and put up good profits. This phase, if you look at the US market, there are some very eloquent graphs looking back to the early 80s where we see that the reserve releases have come to an end. Insurers, reinsurers in the US cannot release anymore. So we are going to enter into this kind of very, very painful phase where the underlying trends will continue, if not accelerate, and the buffers that you would have previously simply have disappeared. So I think the COVID should probably accelerate that discovery process of how is when the tide is low that you see who's swimming naked. Now we have entered a decreasing tide phase, and we're going to see a few naked swimmers.
Oh, we should look forward to that. From a Scor perspective, do you think this is now time to go for top line growth and give the same cover as you were giving before? Or are you looking to get more bang for your buck to just increase the profitability of your book that you have now and not grow?
Yeah, I mean, as an underwriter, you want to provide value to your clients. So ideally, we would want more bucks for the same cover, if not increase the cover. So this is the underwriter's preference, and I think this is the behavior that will be dictating our approach most of the time, as in principle. Now, the way underwriting year accounts work in interaction with financial year is there is clearly some lag. So what we're going to see most likely, like in any kind of crisis, is the financial hit comes very quickly. And even though the business that we're underwriting is a lot better priced, a lot better underwritten, this profitability will only show in the financial accounts 2-3 years down the line. So I think, what we should expect to your question on top line growth, our current focus is to, and we've been doing that till the summer, is to assess the exposure with the information we have. And that translates into a hit. So for the first half 2020, the Scor Group had just over break even for the half year. So that's, disappointing. That's 4 years in a row after a number of cat events in the US and Japan. So there is a very much of a pain element in the very, very near term. So our focus, I would say, is not so much to grow just yet, is to ensure that we can measure exposures, point one, and point two, that we can obtain returns for the capital we put at work. And this is the kind of discussions, the points I was making earlier, get the right bucks for your capital. So bottom line, I would say, and ensuring that we have the right ingredients to have the right returns going forward. Now, long term, growth is not we don't have any growth target at Scor whatsoever. We have two targets. One is a solvency target, and the other one is a profitability target. So growth, if you wish, is a byproduct of capital and profitability, not a priority as such. I think before getting onto the growth agenda, we need to really review the portfolios. We need to engage. We need to improve the profitability, and growth will follow through. And as I said, on the reinsurance side, the hardening is progressive. It's not a hockey stick progression. So we need to be extremely focused on extracting better returns in the very near term. And longer term, look, it's on one hand, there's going to be greater risk aversion, which is always good for appetite for insurance. On the other hand, economic activity has been contracting and will continue to contract. And this clearly doesn't help insurance. So we'll see how both play out and how they impact the top line. But I can tell you, Mark, the top line per se, I think has been way too much of a focus for industry. And we've been seeing the price of that in the past couple of years.
Do you think fundamental demand for reinsurance is going to be up just because uncertainty's up?
Yes, I think so. This is a sweeping comment, but generally speaking, you should expect appetite for protection to be higher. What we see on the insurance side, so in our specialty insurance operations, sometimes self-insurance is our biggest competitor. A number of clients just do not want to pay up and they increase retentions, they just self-insure. The question is, how sustainable is that? How long can they sustain that volatility? So here, in a way, this feeds as well my previous answer to your question is the top line doesn't come in straight away because the initial response from certain clients, and sometimes the better ones, is actually we won't pay up and we will retain more risks. But given the volatility being on the rise, we were confident that over time they'll come back to the market.
We've seen lots of capital raising. Most of the ones, what we've seen has been from incumbents. There have been lots of stories about potential capital raising for a class of 2020 or 2021. What's the nature of that capital raising in your opinion? Do you think it's been more defensive or has it been more potentially aggressive to help fund growth into this harder market?
So there are 2 or 3 types of capital. If you are speaking equity capital, with a few exceptions, I would say that the vast majority has been really defensive. Of course, with some kind of rhetoric around being stronger, taking advantage. But from what we saw at the beginning or even a bit later, let's be honest, they've all been defensive. Most of them are raising capital when their stock trades at a discount. So you have to be really, really confident that the future opportunities are really worth it because you've been diluting your shareholders. So I think if you're talking equity capital, and really we're talking here listed companies much more than private companies, again with a few exceptions, it has been defensive despite the rhetoric. What's interesting is we see different types of capital, namely debt and sidecars. And here I would have a bit of a different view on that. Those allow a lot more flexible capital allocation. They're not dilutive to the shareholders, so the expected return in front of it is lower. There is a temptation to look at the class of 2020. Personally, I think it's misleading to look at it that way just yet.
I suppose it hasn't really happened yet.
Exactly, it hasn't happened. It hasn't happened, and I think what has changed as well. If you really look at the last class, it's a class of 2005, and that's 15 years ago. So it's a lot of time, and in that meantime, the volatility of investors, of capital markets has shot up significantly. So the time horizon of investors is a lot shorter. So a number of private equity investors do not necessarily look at insurance as able to return over 3 and 5 years, which is a typical time horizon. And so many of these private equity funds have developed opportunistic or shorter term funds, which are much better suited to sidecars. So my answer would be a bit different for sidecars. We're seeing a few of them. Now, a number of financial investors in ILS are bruised, so maybe the sidecars would have to be fed by new financial investors. But here I think there is some interesting ones, much more targeted, offensive on the debt and sidecar side, much more than the equity side.
And what sort of opportunity, if this class of 2020 appears eventually, what sort of opportunity do you think they've got? Is it a broad one, or is it very narrow, and is it quite focused?
So far it's been very focused, and so far what you're really talking about, where there is a proper old school hard market, it's contingency, retro, and to some extent, but even then it's even lower property cat. But retro and contingency, proper dislocation, really lack of capital there, and this is proper hard market. But this is quite narrow in the scheme of things. If you look more generally speaking, I think you can look at a few areas where clearly there are some opportunities. And going back to what we're saying, personally, I think much more short tail classes than long tail classes. Here, the returns are much more adequate. There is proper opportunities. Clearly much more personal lines and large industrial lines. I mean, in this COVID crisis, SMEs are the hardest hit. And I think there's going to be a real squeeze for them and probably leading to higher claims activity. On the personal line side, there's been huge resilience. And on the large commercial line side, there's been so much claims in the past 5 years or so that market has started responding already a couple of years ago. And we see that segment continuing responding. A third type of opportunity that we see is, and again, accelerated by COVID, is the digital players. I mean, I don't know if you've looked at the Ant Financial IPO prospectus. It's amazing. The volumes we're talking about here, the transformation of the insurance industry and how it works in the platform, in the broader platform, among other financial services, there's a huge transformation of Insurtechs. And I'm talking here of Ant Financial because we only talk about the US. But of course, in the US, the Lemonade IPO was amazing, and you see quite a few other ones coming to the market. So here, I think there is again an opportunity, which is not exactly a hard market, but there is a real opportunity on digital players. And last but not least, and this is maybe more specific to a player like Scor, we haven't really operated with third-party capital. And I think third-party capital has been the privilege, if you wish, of Bermuda players, some London market players, and many of them got trapped somehow. And I think it does create opportunities for traditional reinsurers, and we're not the only ones, trusted by capital markets and with actually fairly limited engagement with capital markets. And so we're clearly seeing an opportunity for us here with third-party capital, as we have been fairly less active relative to our competitors.
And is that like to be in short tail, or could it be like a really nice, diverse, multi-line thing?
Yeah, either way, yeah. It can be both, and depending on investors' appetites, there is. So I think the real hard traditional old school hard market is on the contingency retro market, but there is a growing opportunity and a hardening market, I would say, in other subsegments of the reinsurance market.
Okay, so we'll have to watch this space and see if anything comes of what you've just said. Laurent, Scor's been in Lloyd's for quite a while now with the Channel Syndicate, and you've been patiently building your presence there. We've had a lot of reform, there's a lot of change in Lloyd's. Any parts of the Lloyd's blueprint for a start that have caught your interest? And let's have a discussion about your position in Lloyd's and that platform and how you see things going there.
Yeah, sure, of course. I mean, you've mentioned Scor Channel, our own syndicate, but we back as well a number of third-party syndicates, and we reinsure a number of Lloyd syndicates. So altogether, to give you an idea, Mark, about 10% of Scor Gold P&C's premiums come from Lloyd's, and we are a meaningful capital provider at Lloyd's. So of course, we've been watching very closely and engaging with Lloyd's at all levels of our respective organizations. Now, for me, on the blueprint, I've read it carefully. I've been following it. I think there are a number of few questions. I'll comment on two of them. One is, I think it sets out very well a global picture of how Lloyd's operates. It's a marketplace and at the same time considers itself as a risk taker. And that I think is interesting, is not choosing between the two. I think the motto is risk taking in a braver world. Now, I think in the economy that we're in, and we have been, and it will only accelerate, you have to be good at what you do. And being a generalist, I think, hasn't paid off so well. And what I think is interesting is I've noticed that Lloyd's ambitions are global. They're very large, very ambitious. Question is, what I would be looking forward to is how do we define priorities and how do we define focus? And that for me is one area where I think Lloyd's has done already a lot of work, and there are some very interesting directions there, but where perhaps we need to, Lloyd's will probably have to choose, and being a marketplace is not the same as being a risk taker. There are very fundamental differences. And the second point is the value, is the attention to value of insurance, whether it is on the cost front. The cost of transaction is of course a key area in the insurance industry, generally speaking, and at Lloyd's in particular, but as well through innovation. And going back to our previous discussion on COVID, for me, if you go back in 2008, the bankers were the villains. I think in this crisis, in the COVID crisis, insurers are way more at risk of being the villains. And why that? Because we realize that the product we sell has no value. We think, policyholders think it's going to respond, well, actually it doesn't respond. There are those legal battles that are going to be endless and very often, without much merit. The coverage is just not there. So the question is, what is the value of insurance cover? And this for me is very much present in the blueprint. The focus on innovation is a very interesting one. And I think Lloyd's has very much understood that they have to be at the forefront of innovation, like actually Lloyd's has always been, to bring more value into the insurance products. So for me, it's really these two things, is the positioning of Lloyd's. Is it a marketplace? Is it a risk taker? I think there's still a bit of ambiguity. And second is, what is the value of what we sell? What is the value of our market? And these two areas to me clearly have been drawing my attention and driven a number of discussions internally.
We had Vicky Carter on this program in a previous episode, was talking about someone who's a specialist in providing trade capital to Lloyd's syndicates. And obviously you're one of the biggest providers of trade capital still. Is that going to be a very hard renewal coming up for 2021?
Yes, I think so. Because the trade capital business has changed quite a bit over time. There was some very interesting analysis in the blueprint paper back in May, showing that the nature of the capital backing Lloyd syndicates has completely changed over time. And it's not at all the same to regulate a multinational global organization or that provides capital at Lloyd's, or a population of wealthy individuals who have their own wealth at work backing insurance risks. And this, I think, is interesting. I mean, Lloyd's, of course, are looking to have more diversity in their capital providers, but the reality today is that the vast majority of those providing capital are overly regulated entities by themselves, before speaking of the additional Lloyd's layer. And here I think it is something I had in mind when I was talking of, Lloyd's will have to choose between being a marketplace and a risk taker. I think it's when you are a risk taker yourself, and a global one and a sophisticated one, you do have fairly strict governance already. So when you back those syndicates, you want a disclosure that perhaps goes beyond what you already get. You want a transparency that I think has to probably improve over time. And I think the whole process of controlling the syndicates is as well creating some slowness. So I think the third-party capital space, I think, is going to be a difficult one in its traditional form at Lloyd's. Whether financial investors will re-enter that space is yet to be seen. I mean, the leverage rules are far less flexible, far less appealing. So that would be interesting space to watch. And I know that Vicky is a keen advocate and a great ambassador of syndicates among capital providers.
You mentioned about COVID cover. Do you think this has to be something, has to be a public-private partnership? Obviously, within Scor, within your home market in France, I'm sure you're very close to the French state in many ways. What's the thinking? We've got lots of different future pandemic insurance solutions in the form of a bit like some of the pooling arrangements we have with state-backed situations like we have with terrorism around the world. Which of those mechanisms do you think is most likely to be a successful one?
So far, from what I've seen, there isn't really any that has attracted my attention in a way to say, well, that one is really going to take off. I think, there are some interesting ideas around parametric covers. When you talk about SMEs, when you talk about smaller economic agents, the basis risk on parametric covers, are they really politically acceptable? Are they socially acceptable? I don't think so. But there's been some interesting innovation there. I think, generally speaking, the debate is still highly politicized and probably too much to have really the foundations of a stable risk-taking partnership. I think we aspire at Scor to have as a reinsurer, to have a role to play, and we think that reinsurers have a role to play in those schemes. But we should make no mistake, when you cannot diversify the risk, when you're talking of a global kind of risk, there will be limitations very quickly from the private sector.
So you just can't write a very big limit, can you?
Correct. And then the question is do you try to mutualize it with other extreme events, which, given the nature of these events, actually you don't really mutualize. You add huge uncertainties to other ones. So it creates really kind of way too black boxes. If you provide covers only for this single peril, I think the issue becomes then the relevance. And I think it goes to the relevance of the reinsurance industry capital in the scheme of things. There were some very interesting discussions on BI covers in the US when there were some rumors that the BI wording would be ignored and changed and that insurers would have to pay BI coverage. Then you realize that actually the US insurance company surplus is tiny compared to the economic amounts at stake. So I think in the end, governments will have to step in. We'll have to find some schemes to have some encouragement to risk management behaviors and mitigation of the risks. But I think it's still very early days to see anything.
So you think it's more likely the insurance industry is going to be more of the conduit for these payments, rather and at least for helping with risk management and things like that.
Exactly. I hope a bit more than a conduit, but for sure an agent of governments. I think that could be interesting.
Yeah, because we had a situation in many countries where there was no real mechanism by which a government could pay a subsidy to a business to keep it open. They didn't really have that same relationship. It would have been easier for it to be done through their insurance if they had some.
Correct.
You mentioned about Lemonade, and obviously we've got this big IPO coming up with Ant Financial, the Chinese financial conglomerate. What do you make of this Lemonade IPO? I bet, of course, I'm sure you and Denis would wish that Scor could trade on the same multiple as Lemonade, which is, I haven't looked at the share price today, but it's many times what most of the industry average is for most publicly quoted insurance companies. Is that some kind of watershed moment? We've been talking about Insurtech for a long time, and Lemonade has been kind of the poster child for Insurtech, and now it's had an IPO and it's been an absolute blast. Is this just going to unleash even more investment from tech investors? And are we going to, we've already seen, we could have described this the last 4 or 5 years as being a bit of a bubble. Do you think this is just the beginning? Is this like the Netscape IPO, but for Insurtech?
For me, it goes to a broader theme, which is that there's so much liquidity in the capital out there that there is a huge disconnect between public markets, equity markets, and the underlying economics, which means that, yes, there is a bubble. The route is coming to the IPO. There is more IPOs coming through and so on. So I think it would be probably misleading to take for face value the current situation on capital markets. And I can tell you that actually, I think for a very short period, the market cap of Lemonade was actually, if not bigger, very close to Scor's market cap. And it didn't escape our attention. So I think, there is perhaps an element of excessive interest, exuberance, if you wish, on the valuation of those companies. But I think we should not be complacent. I think this wave of Insurtech is not here to stay, it's here to grow, it's here to accelerate. So I cannot comment on the valuations and the multiples of these companies. I don't know what it will be, but I'm pretty sure that they will get broader. I mean, when I read some of the comments, people saying, well, they're very narrow, they're on renters and so on. I think, of course, all of these players are going to reach out to much more segments and it will grow. Of course, the profitability will normalize and they will get to economies of scale and risk selection that will make them viable. So personally, I'm not very comfortable when I see the valuations, but I'm very confident that those insurance players, whether they are insurance companies, agents, distributors, will gain market share in a tremendous way. And if you look back, financial services, banking, the transformation that has been at work over the past 20 years has been huge. And this has taken place outside of the large institutions, banks, insurance companies. And the fintech industry is a huge component now. And I think it's tempting to dismiss that, to miss that elephant in the room. But I think we're going to see more of these.
So it's fair to say there's plenty of value being created, whether the valuation is one thing, but there's a lot of value and there's going to be more value being created in this way long into the future.
I believe so, absolutely. And COVID and the drive to a digital economy, the resilience of the digital economy has been proven through COVID. I think has been an amazing test case for a lot of these digital businesses. So I'm hugely optimistic about the future of these businesses, absolutely.
Another very technological business that's a publicly quoted company with a fantastic valuation that dwarfs many of its more traditional incumbents is a business like Tesla. We've been seeing them getting into insurance recently. Is that good news for a progressive reinsurer like Scor, or is it something we should be worrying about, where this is a business that's saying to the rest of the market, we don't really need you. We've got tons of capital. We've got very happy investors who are happy to fund whatever we want to do. If they decide they want to do insurance, do you think they could do so? Or do you think they're always going to need a partner and they're always going to need reinsurance?
Look, I think it's a very good news. Whenever there is greater value of the insurance product, whenever there is incumbents in an overly regulated industry where barriers to entry are supposed to be super high, it's a good news. And if it's good news for our industry, it's going to be good news for those who can, take advantage of it. And I'm pretty sure that there will be ways to raise partnerships. There is a risk management know-how. There is ways to manage volatility, which will represent opportunities for the reinsurers who can operate with those players. So for me, it's Google made an announcement in health insurance a few days ago.
Yes,
there's a number of very interesting disruptions going on, and I think that's good news for our industry. It would be bringing more value to the end customer, to the consumer.
And what you just said, there's of course everybody still needs to manage that. However good they are at insurance, they still need reinsurance because they need to manage their own volatility.
Absolutely, and you could see through the Wirecard scandal recently, the appetite for bankruptcy, the appetite for fraud is decreasing, so that the volatility remains there. It cannot be completely swallowed. So there will be room for risk takers, of course.
Given your amazing visibility, global visibility around the world in all sorts of markets, where's the best place for your money at the moment? Which segment of the market in the world are you most excited about and you most sort of?
As we speak, and maybe I have a bias here again because I lead our specialty insurance operations. It's in our large commercial lines insurance and fact business. We are much more of a first party than a third party operator. So property rates, energy rates, first party market on large commercial lines is really booming. We have a very technical engineering focus, which means that we have not grown in the past 15 years. So we didn't have the same issues a number of our competitors have been having. So for us, it's quite an interesting market where we make money on our current book and we expand our market share because a number of our competitors have huge changes in their risk appetite. So we can really demonstrate our cycle management capabilities on large commercial lines. And so that, as we speak, it's running pretty well.
you've got your reward for being patient and being disciplined after a very long time, I presume.
And we've accepted not to grow, exactly. And we've resisted this pressure from capital markets, from outside commentators, and we've kept our head low, and it is now paying off, yes.
Great. Well, that's good to hear. Good to hear. And I'd like to wish you all the best and look forward to the upcoming renewals. And before we go, I'd like to just thank you for your time and make sure you know you're welcome to come back anytime soon and give us an update. So thank you very much for your time.
Thank you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Thanks for listening. And once again, big thanks to today's supporter, Claims Direct Access. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.